Hello and welcome to The Upside. I'm Kyle Cheropita. On today's episode of The Upside, we'll be reflecting on the month of June. US, global, and Canadian equities rallied in June, while oil prices swung as a result of tension in the Middle East. Today, we're counting down the top 5 highlights from our Fidelity Connects show. Connects is live daily for advisors and then available on replay for all as a video podcast. Number 5. We spoke to portfolio manager David Tulk on June 5th, the day after the latest Bank of Canada announcement. David Tulk and his global asset allocation team members, David Wolf and Delon Collette, all previously worked at the Bank of Canada. And in his Connects webcast, David shared his thoughts on the bank's decision to leave interest rates at 2.75% after several prior cuts. Here, with host Pamela Ritchie, David expands on trade, the US and Canadian dollar, and overweights and underweights in GAA's funds.
I think you were mentioning you're taking a look at some trade data, trade deficit. I wonder if deficit will be up there for one of the contenders of words of the year. Trade deficits, but also obviously the deficits the US is battling in its own market, making sure they're issuing debt in order to cover their deficits and so on. It's an ongoing story, and it's sent some ripples of concern through the global economy, certainly through the dollar. I wonder if we can kind of bring up the state of affairs in the United States as it pertains to how you are investing and taking a look at it from an asset allocation perspective. The US dollar is lower. There is a significant debt issue, and then of course all the tariff stuff.
Exactly, yeah. So before getting to the US, I think it's really important just to maybe focus on that trade data that came out earlier this morning. So that was for, at least in the Canadian context, that was the largest trade deficit we've ever seen. So close
with
to 7.
The US?
No, in total, but the vast majority of it was into the US. So $7 billion, and that was really the center of the storm when you think about the tariffs, the Liberation Day being announced, and what it really did to the auto industry. But it also, I think, underscores a point that Canada is trying to wrestle with. So when we think a little bit about Canada's plan in all of this, we have obviously really built our economy in a way that it exports to the US and really benefits from US strength. And we try now to think about ways we can diversify. So part of that will happen within Canada's borders, but also a big part of that would be to try to export to countries other than the United States. So in this trade data, we actually saw that exports to countries other than the US increased marginally, but it was just utterly swamped by that trade relationship with the US. So that kind of underscores the size of the task that the Canadian economy is trying to wrestle with. But let me come back to your question a little bit about the US and how we were thinking about the US. And I think this is a really important theme. So this is one of those things that I think can have implications, not just for the current electoral cycle or the current government, but really something that underpins a long-term view that we're taking with respect to the US. So if we take a step back and think about the last 20 or 30 years, it was really a world, I think, of US exceptionalism. And it was a world of emergent technology. It was a world where you saw a lot more globalization. And a lot of that was really benefiting the United States. So it really led rise to that longer term trend of US dollar strength and US exceptionalism. Now, what we've seen over a very short period of time is a pretty significant challenge to that US exceptionalism.
Right.
Some of it is certainly self-inflicted, and we can get into some of the policy mechanics that are behind that. But I think really the key takeaway for investors is that you really can't necessarily trust the US as much as you could previously. There are still great companies there. We still use a lot of active managers who are finding great ideas. But from an asset allocation perspective, especially as a Canadian investor, I think you need to be wary of what the currency is doing. So as we've saw the US dollar strength, certainly one of those dominant themes, but now I think we're in a period of prolonged US dollar weakness.
You do? Okay.
I do think
that's
that.
massive. Yeah.
So from where we sit, again, if you're holding securities in the US, you can't just think of that return in local currency terms. You now have to overlay the risk that the US dollar could continue to depreciate on a trend basis, and that will lower your returns in Canadian dollars. So that's something that we can certainly unpack further, but it has some pretty significant implications. So I'll just quickly sort of summarize how we're positioned around that.
Good. Yeah, because you had a pretty significant underweight to the Canadian dollar based on all those reasons of us being right next to it and, of course, currency being so relative.
Yeah, so on the Canadian dollar relative to the US, I mean, we've trimmed that underweight pretty sizably. To give you a sense of our longer term views on the Canadian dollar, my colleague David Wolf has talked a lot about in the past of expecting perhaps a return to the lows that we saw of a 62-cent dollar, Canadian dollar versus the US. And just to give a sense of how significant this change has been, he no longer believes that. And I think that's a view that I share as well, that the balance of risk for the Canadian dollar is probably to move higher from here. So as a result, we've really trimmed that underweight we had to the Canadian dollar. What we've also done is we've really tried to shed US assets more generally. So on the equity side of the portfolio, we started the year with an overweight to US equities. We're now underweight US equities with a preference for a more diversified basket of international equities. So that's really what we're doing.
Does that include Canadian equities?
So we're still a little bit underweight Canadian equities, but the direction of travel for us is, again, along the lines of what we've done with the currency, is to really trim the size of the underweight. So there still are some Canadian challenges that I'm happy to unpack, but given the wider trends that we've seen with the US and with some of these global forces, I think we need to be much more diversified in how we think about allocating to markets outside of North America.
Up next is clip number 4. Expanding on the discussion of tariffs and trade, here is Denise Chisholm, Director of Quantitative Market Strategy, with her thoughts on the state of the economy, the cost of goods, income, and inflation. Hopefully Denise is a familiar face to you. She's a frequent guest on both FidelityConnects and The Upside. Take a look at this clip from her mid-June Connect show.
I want to ask you about some of the things going on in the economy right now because we have some new data points. But just take us back to when tariffs hit and what everyone was earning at the time in terms of what they were feeling like in their own back pockets.
Yeah, I think everyone was worried that tariffs, once they hit, would increase the cost of goods that everybody was buying and real incomes would decline. And real incomes just recently declined in 2022. So that was a very recent event. And in fact, it was the biggest decline in real income we've ever seen without a recession, meaning nobody lost their jobs, but income grew slower than inflation. So that was the fear. But this is exactly the opposite setup than where we were in 2022. Despite the fact that tariffs have, sort of started dribbling into the US economy, maybe the full impact hasn't been felt yet. But despite some of the dribbling in, what we're seeing is an acceleration in nominal income growth and real income growth, so adjusted for inflation. And this is really important because, to your point, starting points matter.
That's
and
your
the
point.
Reason matter is because the reason why they matter is because this is very correlated to future earnings growth, meaning that if the consumer is in good shape with a very clear tailwind of real income growth, that usually bodes very well for earnings growth over the next 12 months. So if we rewind and say, well, one of the things that we were worried about was a contraction in real income and a contraction in corporate profit growth, this might be saying exactly the opposite. The setup is better than you think, and maybe earnings revisions that we saw over the course of the last, month or two were really overdone.
So when we saw comments, and we have seen comments out of the U.S. administration, and they've been interpreted in lots of different ways. I think certain companies, particularly consumer-facing companies, told actually to eat the tariffs and not pass them on to consumers. There was sort of that discussion and debate and headlines and so on. But in fact, consumers, based on this, could afford it, actually, could afford to have the tariffs passed on at that time.
I think that's exactly the right way to think about it. Another way to say it is there's a whole lot of offsets. So yes, prices of some goods will in fact increase, but there could be offsets in other places, either where the consumer decides not to spend money or to spend money. So it doesn't always mean, and we saw this in 2018, albeit on a very, very much smaller scale. If the price of washing machines goes up, yes, that's going to be one of the drivers into goods, but the prices of other goods and services might offer an offset. One of the key offsets for the consumer that we've talked about is the decline in oil prices. Right. So if we think back to that tariff math, we can make guesses about it, but in some ways, despite the fact that tariffs are new for us this time in this magnitude since 1930, tariffs are essentially a tax. We just have to make some guesses on who they hit and when. So the who they hit, if they hit in terms of half comes to the US consumer, and we're talking about a 15% aggregate tariff rate, which is a little more than what we are right now currently. If that hit to the US consumer, half falls to them, that's $250 billion. That decline in oil prices exactly matches it by about $250 billion. So back to your point, there could be a situation where the consumer actually can afford it.
Next, number 3. Tom Stevenson, Investment Director at Fidelity International, joined us recently on Connects and comments here on US versus Europe, a debated topic that's shifted throughout the year. Tom speaks to valuations, interest rates, and the overall economy.
Let's talk a little bit about valuations within Europe based on everything that you've just been discussing, those 2 points that you were making. Valuations have come up substantially. It's been a win for European equities through the first half of 2025. I think there's a lot of questions about whether it has legs. Does it keep going? Have you missed it? What needs to be added? You were talking about defense spending will creep up. I guess the question is it priced in?
Yeah. So, I mean, I think, first point, we started from a pretty low base in Europe in terms of valuations. So what we've seen over the last 6 months is a bit of a convergence in valuations. Very high valuations in the US have started to come down, and they've certainly started to rise. There's still a gap between the two, a significant gap. So I don't think that valuations by themselves are a reason to think that you've missed the boat, for example, with the European trade. In terms of earnings, actually, what we're seeing is a slowdown in the US economy, and that's feeding through to slower earnings expectations. And we're seeing the opposite in Europe. We're seeing earnings expectations actually rising. So we're seeing a convergence there as well. And I think that is a precondition for a narrowing of the valuation gap as well. And then I think the other point that I would make, in terms of making the case for Europe, is what we've seen over the last couple of years is a sharp reduction in the cost of borrowing in Europe. The ECB has cut interest rates from about 4% to 2%, so they've halved in Europe, whereas what we're seeing in the US, very much the Fed sitting on its hands, waiting to see what the impact of tariffs will be on growth and inflation. Much to the irritation of the president, of course, because he's very keen for the Federal Reserve to get on with it and to cut interest rates. And in my view, quite rightly, the Fed is saying, no, hang on, let's wait and see what the impact is going to be. But that has opened up a significant gap in terms of policy between Europe and the US.
Well, okay, so let's go into there's so many pieces of this I want to ask you about, but let's go into the discussion of the dollar. The interest rate differential is huge between the United States and many other countries, Bank of England, Canada, that have been cutting for lots of good reasons in their own countries and different reasons. But in any case, the Fed is holding a bit longer. And there is this interest rate differential, which should make the dollar stronger. There's another number of stories for where the dollar is going right now. I wonder if you can sort of take on that differential and its impact on. Is it possible that currencies is actually, maybe not geopolitical, but otherwise, the story of the year so far?
Yeah, well, it's certainly an interesting story because, as you say, you would expect that interest rate differential to lead to a stronger dollar. You would expect the geopolitical uncertainty to lead to a flight to safety, the typical safe havens being the dollar and US treasuries. We've not seen that happen. We've seen
a bid today into the dollar.
We have today, yeah, and then almost for the first time in a couple of months, the dollar has started to behave in a way that you would expect it to behave. But I mean, it's a fairly marginal increase. But yeah, you're right. It has been different today. But prior to that, we've seen a weakening of the dollar when you would not have expected it, and I think that is a reflection of changing. Attitude towards the US's safe haven characteristics. It's in terms of the predictability of its policy, in terms of the what is broadly called the US exceptionalism story. I mean, there are now question marks as to whether the US will deliver consistently higher profitability and returns on capital in the way that it has in the past. And that's part of this rotation. Many investors over many years have become very heavily exposed to the US because of that exceptionalism story, and that is disappearing, and it's showing up in the dollar certainly. Now that has knock-on impacts for other regions and asset classes. For example, I was talking just this morning to one of my colleagues about emerging markets, and she was pointing out that dollar weakness is typically a positive for emerging markets for a number of reasons. It's good for commodity prices. It lowers the cost of servicing US dollar denominated debts, for example. So a falling dollar is normally good for emerging markets. We haven't yet seen that. And one of the reasons why we haven't seen it in emerging markets is that all the focus, as we've been discussing, has been on Europe. And I think so, if you were looking for other areas of the world where there might be interest to come, if you think, well, maybe if Europe's had its run, and it has certainly enjoyed a run, then I think emerging markets might be somewhere interesting to look at as well.
So for more from Tom, he'll be joining me on Monday, July 7th, Upside webcast at 12:30 p.m. Eastern. We hope you'll tune in for that show too. So next up, clip number 2 is Etienne Jean-Bouchard, Director of ETFs and Alternative Strategy, speaking on the power of diversification and the advantages of the Fidelity All-in-One ETFs. This includes how and when the products are rebalanced and the strength of the quantitative research team behind these ETFs. Also, an interview with the head of the quantitative research and investments team, Neil Constable, is coming up later in July, so please keep an eye out for that show. Here's Etienne and Pamela.
One of the things I just want to pick up on that I think you were saying there is the idea of being so diversified, and you can do that within an all-American investment case or international or any of the all-in-ones with the different strategies for balance and so on. But there's an ability there that it strikes me, it allows investors, because it is so diversified in its strategy and the way it's designed, to hold on through these markets and to ultimately not hit the sell button, right? There's an ability that something else will catch you, even if another piece of that area of the investment universe is falling.
100%, and it's almost going back to the concept of systematic investing or factor investing or
right.
Quant investing is, because of the nature of the structure, the methodology does not allow for daily changes. It doesn't. There's fixed rebalancing periods, and depending on when that falls, that might mean that we have a lot of rotation in the portfolio. It might mean we don't have rotation in the portfolio. What it is not doing is reacting to headlines. It's not reacting to news. It's not reacting to behavioral shifts that we've seen in the market. It's literally just relying on data. So unless there's a fundamental change to a certain sector, a certain company, a certain geography to a certain extent, it's not going to react to it unless it starts to see the data change. So valuations move up, profitability, or basically margins coming down. Like, it's going to react. Yes, albeit you could argue that it's going to be reactionary and not, proactive, but that's a good and bad thing in certain, but it's just understanding that that's kind of the way that factor strategies work. And obviously they've shown to work over time. It's just a different approach than active management, for example.
Etienne, did you start as a quant?
Not really. I'm more kind of a trained. I wouldn't even consider myself a quant. Like the true experts are our quantitative index team in Boston. These are the folks that have created a lot of our index or like strategies. I say index like strategies, and I don't want people to associate that with passive investing, because passive investing just means market cap based indexes. Our indexes that we build are based on a bunch of other criteria that are proprietary that we've built at Fidelity. Those are the real quants. Those are the real smart folks. I'm kind of more the, the face now of a lot of these portfolios, but the construction and the real hard work was done
come from a
by our
rocket
quantitative
scientist
index team.
Yeah, you've
exactly.
got a rocket scientist, Bobby Barnes, heading that up. That's fantastic. Now I want to kind of ask you the other side of being able to hold on, not reacting to headlines, as you mentioned, but at the same time, for instance, wanting to capture some of the changes that are going on in the market, in this massive macro-led market, or largely macro-led market. For instance, there was a time when, if you're looking international, there's certain things that popped up at certain times. I guess, how do you capture some of the things that are large, momentous, and make sure that you're not so smoothed out that you're not getting exposure to the stuff that's upside?
For sure. For sure, and you know, and hence kind of why like also we rebalance at least twice a year. Like we're trying to, as things change, to react. We don't want to not capture any major shifts, and obviously the one that's going to be the most reactionary and the one that captures the most momentum is the momentum factor, which rebalances quarterly, which is looking at not only price changes, but did a certain company miss or hit on their earnings estimates. Like these are things that we also consider when selecting those stocks based on momentum. That's really the one that's going to capture those changes, and hence why it's somewhat like a chameleon to a certain extent, where one quarter to another it can change fairly rapidly, right? So to look at it and say, oh, I like this ETF because it's got 35% allocation to tech in the U.S. Well, that could go down to 20 the quarter after if all of a sudden it goes out of favor. So the momentum factor is really unique, whereas you kind of just gotta trust the process, if you will, right. And it generally works over time, but it's going to be fairly different from a quarter to a quarter, and especially year over year. So if somebody's looking for that, that's one way to do it for sure. And obviously another way to do it is using an active manager that's got his very good pulse set on the markets, which we have a bunch of great managers here at Fidelity.
I got a number of those.
For more from Etienne, the first episode of his new podcast, Ticker Talk, drops in early July, which you can find by searching The Upside Ticker Talk on YouTube, Spotify, or your favorite podcast app. So, to bring things home today is portfolio manager Darren Leckekircher with June clip number 1. Darren started his webcast speaking with Pamela about how he and other Fidelity portfolio managers use volatility to their advantage, like what we've seen this year, specifically in April. As you'll see here, Darren expands on what's currently exciting in his portfolio, Fidelity North American Equity Class.
Take us into a little bit of what's in the portfolio high level.
Yeah, so definitely in the communication side of things, in both the media streaming in terms of both like sort of TV streaming, movie streaming, as well as like music streaming, as well as like digital ads, and also technology. I would include software, businesses like that. And so like stocks got crushed, right? And I think there was also a view that the consumer would roll over and there would be a terrible recession. And look, I mean, the jury's still out on that, but I would say that I think people would think it's not going to be as bad today, or the outlook is much better than it was certainly 2 months ago. And for some of these companies that weren't impacted, I also bought more of them because I really like them, and they've done well. And so for example, one of my top 10 positions is the largest streaming company in the world in terms of like movies and TV, and I've owned it. I think I've owned it for two years, maybe a little bit longer than 2 years. And I think that there was a great opportunity to buy this company in 2022 when the stock really got crushed. Since then, they've had two very nice growth arcs in terms of eliminating password sharing, as well as adding advertising.
Gee, I wonder what the company is.
Yeah, and I think it adds so much value.
But people don't cut their streaming even in a recession, right?
No, I think they probably have more time to watch. I think you got to do something.
Yeah, you got to.
And so and I think it's a really incredible value, right? And so I think that like if you compare what's the price of your streaming subscription to cable, I think it's a good value. If you're buying 10 of them, it's probably not. But if you're buying 1 or 2, it probably is. And as a result, they've been able to increase the price because they look and see what's consumer engagement, how much are consumers watching. The average consumer watches like 2 hours of Netflix a day or something like that. So they've been able to raise price, they've been able to get subscriptions, the background's less competitive, margins are going up.
So tell us a little bit about this fund a bit, because we know it's North American equity. Does that mean you need to either choose, from your perspective, do you need to kind of lean one way or the other? Presumably you have a mix of both, but to what extent do you have a mix of both Canada and the US?
Yeah, so the fund, when we started it, we started it 10 years ago. It'll be this October, so it's going to approach its 10-year anniversary.
You've got a happy anniversary coming here.
Yes,
okay.
Yes. And
Fantastic.
So when we structured the fund, we structured it as giving it flexibility, but with a benchmark of 70% US and 30% Canada.
Okay.
So I'd say as of today, it's pretty close to that. It's 66% US and 34% Canadian. The Canadian portion, I wouldn't think of that as like 34% of a Canadian fund. I would think of that as the best of Canada. And so think about Canada, right? And I think...
So you're not owning everything in Canada, sort of evening it out in that sense. Like
no.
Having a bit of everything.
And, I think there's a big misconception globally and within Canada and what Canada is. Like, what's Canada? When people think about Canada, if I go to the US, I tell my American friends, what's Canada? They think of energy, they think of mining, they think of banks. That's what they think
and
of,
maple
right?
syrup.
But yeah, exactly, right? And but what's been winning in the Canadian market? What's been working? It's the quality compounders, right? Those are the types of companies that I'm trying to own, not only in Canada but in the US, and that's what I own, right? So Constellation Software is in the top 10. It's been a big holding since for a long time. I think since the inception of the fund.
Oh, really?
And
Okay.
so
That's interesting.
and there's other companies like that, like in engineering services, for example, right, where it's like good organic growth. They're able to deploy capital accretively by buying in-market competitors and grow cash flow. There's waste management companies that are very, very resilient when you have a recession or inflation. They've been able to grow their
Pick
free
up the
cash flow
garbage
very
anyway.
nicely. Yeah, there's the information services companies. So there's a lot of different areas. There's the grocers, the dollar stores. There's a lot of good businesses within Canada that people don't think of necessarily.
So I don't hear, now you also manage natural resources, and I'm not hearing a lot of natural resources in what you just said.
Yeah, so I think within natural resources, I do run the Global Natural Resource Fund with my colleague Joe over to Vest. He runs the energy. He's done a great job. He's a fantastic resource. He's a pun.
Yeah.
And
he won't mind.
And no. And but within resources, I think you got to dream the dream. And so by that I mean you got to invest where there's price appreciation on the commodities.
So not oil right now.
Yeah, so I would say that like for the North American Equity Fund, less than 1% of the fund is in the energy sector.
Okay.
And that includes uranium. So it's even like less than 1%.
Oh, good. I'm so glad you brought that up because
yeah.
there's some headlines around that. Okay, tell us how you're positioned, but then I want to ask you about kind of the future.
Yeah, sure. So I was going to say, in short, it's mostly gold, then copper, then uranium, then energy. But it's pretty small. Like it's less than 1% in uranium and energy.
Right.
The materials would be bigger, but the mining portion is a few percent. And it was mostly in gold. Gold's actually done really well. I know you want to move on, but gold, like I was looking at commodities, right? Since like the last sort of peak was like after the Russia-Ukraine war kind of started in sort of mid 2022. And I think gold was around $2,000 an ounce then, and now it's like it's like $3,300 an ounce. Yeah. Whereas I think oil went from like 120 to low 60s, and copper's kind of remained about flat-ish. It's a little bit under $5 a pound since then. So just to provide some context, but I think you wanted to drill down on uranium or nuclear, given maybe today's.
Yeah, no, I'm delighted to hear. I mean, do you think central bank buying has a lot to do with the gold story?
Yes.
Yeah.
Yes, I do.
Yeah.
I think that
yes.
I think that like post the Russia-Ukraine war, I think that foreign countries really wanted to diversify their financial reserves away from the U.S. dollar, and gold has been a big beneficiary of that.
So that does it for today's show. You can find a full 30-minute video podcast of each of those clips available on YouTube, Spotify, Apple Podcasts, and more. We're putting out fresh content daily, so please look up the Fidelity Connects or the recently launched Upside podcast. I'm sure there's a topic there for everyone. So thanks for watching today, and I hope you'll join us again on the Upside. Please keep an eye on your email to not miss an invite to the next episode. I'm Kyle Cheropita.